Hi guys. Welcome to my channel. Before we get started, make sure to hit that like button, also subscribe to my channel. How to Avert paying tax. So to make sure to watch the full video. Income is subject to federal, state, and local taxes, and earned income is additionally subject to levies to pay for Medicare and Social Security, to name a couple. Although it can be challenging to avoid taxes, there are numerous ways to do so. Here are 6 methods for avoiding paying taxes on your income. What is tax evasion? Tax avoidance is the use of legal strategies to reduce an individual's or a company's income tax liability. The usual method for achieving this is by taking all legal deductions and credits. Putting tax-beneficial investments first, like purchasing tax-free municipal bonds, is another way to accomplish this. Tax avoidance is not the same as tax evasion, which relies on unethical practices like falsifying deductions and underreporting income. Recognizing tax avoidance. Many taxpayers have access to legal means of avoiding taxes or at the very least reducing their tax obligations. In fact, to reduce their legal and legitimate tax debt to the Internal Revenue Service, IRS, millions of people and businesses employ various tax avoidance strategies. Tax evasion is another term for tax sheltering in this context. 2 ways to avoid taxes. Tax-paying entities can evade taxes in a number of ways, as was already mentioned. This includes specific credits, deductions, exclusions, and tax code loopholes that are found in the United States. A few of the resources available to taxpayers to benefit from tax avoidance include the ones listed below. Comparing tax evasion and avoidance. Tax avoidance and tax evasion are frequently confused. Despite the fact that both strategies work to avoid paying taxes, they are very different. Unlike tax evasion, which is wholly illegal, tax avoidance is very legal. When people underreport their income or fail to report it to a taxing agency like the IRS, that is considered tax evasion. If you fail to disclose all of your income, such as tips or bonuses received from your employer, you are engaging in tax evasion. It is also considered tax evasion to claim credits to which you are not entitled. Even if they have filed tax returns, some taxpayers engage in tax evasion by failing to pay their debts. 1. Buy municipal bonds. Purchasing a municipal bond is equivalent to making a loan to a state or local government for a predetermined number of interest payments over a predetermined time frame. The buyer receives a complete return on their initial investment once the bond reaches its maturity date. Depending on where you live, state and local tax exemptions may also apply to municipal bond interest. Municipal bond interest is not subject to federal income tax. Municipal bonds appeal to investors because of tax-free interest payments. Municipal bonds historically have default rates that are lower than those of corporate bonds. According to a study of municipal bonds from 1970 to 2019, investment-grade municipal bonds had a default rate of just 0.1% compared to 2.25% for international corporate issuers. Municipals do, however, frequently have lower interest rates. Municipal bonds are appealing to some investors due to the tax advantages and their tax-equivalent yield. Your tax-equivalent yield rises in proportion to your tax bracket. 2. Strive to achieve long-term capital gains. Growing your wealth can be facilitated by investing. Long-term capital gains are given favorable tax treatment, which is another advantage of investing in stocks, mutual funds, bonds, and real estate. Depending on the investor's income level, a capital asset held by them for more than a year is subject to a preferential tax rate of 0%, 15%, or 20%. The capital gain is taxed at ordinary income rates if the asset is only held for a short period of time before being sold. Growing wealth requires an understanding of the differences between long-term and short-term capital gains rates. If their taxable income is less than $80,800 for a married couple filing jointly and $40,400 for a single person in 2021, they will not be taxed on their long-term capital gains. For 2022, taxable income up to $41,675 for single people and $83,350 for married couples is included in the zero-rate bracket for long-term capital gains. When and how to sell appreciated or depreciated securities to maximize losses and minimize gains can be decided with the aid of a tax planner and investment advisor. By selling securities at a loss, tax loss harvesting can also reduce a capital gains tax obligation. The lesser of the excess losses exceeding capital gains by $3,000 or the net capital loss may be deducted from other income. Over $3,000 worth of capital losses is eligible for carryover to subsequent tax years. 3. Open a business. A side business offers numerous tax benefits in addition to generating additional income. Many costs that are incurred in the normal course of business can be subtracted from income, lowering the overall tax liability. Health insurance premiums, which can be deducted from taxes if certain conditions are met, are particularly significant tax deductions for self-employed people. Additionally, a business owner who strictly complies with IRS regulations may use the home office deduction to partially offset some of their home expenses. It is also possible to deduct from income the portion of utilities and internet used for the business. The taxpayer's operations must be profitable in order to be eligible for these deductions. According to Publication 535, the IRS considers a number of variables. Taxpayers who have seen a profit in 3 of the previous 5 years are assumed to be operating a business for profit. 8. The Secure Act, setting every community up for retirement enhancement, was passed in 2019. Employers who join multiple employer plans and provide retirement options to their employees are eligible for tax incentives under the Secure Act. 4. Maximize employee and retirement benefits. Contributions up to $20,500 to a 401k or 403(b) plan can reduce taxable income in 2022, up from $19,500 in 2021. 10. The basic workplace retirement plan contribution can be increased by $6,500 for those who are 50 or older. For instance, a worker earning $100,000 in 2021 who makes $19,500 in 401k contributions has their taxable income reduced to just $80,500, 11-12. Contributing up to $6,000, $7,000 for those 50 and older, to a conventional individual retirement account, IRA, in 2022 and 2021 can help people who don't have a workplace retirement plan reduce their taxes. Depending on their income, taxpayers with workplace retirement plans, or whose spouses have them, may be able to deduct all or a portion of their traditional IRA contributions from their taxable income. Depending on whether claimed on a single taxpayer's return, joint return, or married individual filing separately, as well as taking into account any participation by a taxpayer in another plan, the deduction for IRA contributions is phased out for adjusted gross incomes at different levels, higher in 2022 than in 2021. Regarding whether and how much you can deduct, the IRS has specific regulations. Prior to the Secure Act, individuals with 401k or IRA accounts were required to take required minimum distributions, RMDs, in the year they turned 72. According to the tax bracket, the account holder is in the year they withdraw. The Secure Act raised that age to 72, which may have tax ramifications. The bill also raises the retirement age for traditional IRA contributions from its previous maximum of 701.25 years old. Additional benefits. Along with retirement plan contributions, many employers provide a range of fringe benefits that permit employees to deduct their contributions and benefits from their income. On employees' W-2 statements, benefits under these programs are typically shown as non-taxable amounts. Flexible spending accounts, educational assistance programs, adoption expense reimbursements, travel expense reimbursements, group term life insurance up to $50,000, and typically for senior managers and executives, deferred compensation arrangements are included in this list of benefits. 5. Use a health savings account, HSA. Health savings accounts, HSAs, are a tax-saving tool for employees with high-deductible health insurance plans. Similar to a 401k, payroll deduction contributions to an HSA, which the employer may match, are not included in the employee's taxable income. In contrast, direct contributions to an HSA are fully deductible from income. The highest deductible contribution amount for 2021 is $3,600 for an individual and $7,200 for a family. 16. These upper limits increased to $3,650 per person and $7,300 per family in 2022. Without having to pay tax on the earnings, these funds can then increase. Withdrawals from an HSA that are used to cover legitimate medical costs are also not subject to taxation. 6. File for tax credits. Taxes can be reduced by a variety of IRS tax credits, such as the Earned Income Tax Credit. With 3 or more qualifying children, a low-income taxpayer may be eligible for credits up to $6,728 for the 2021 tax year, $5,980 for 2, $3,618 for 1, and $543 for none. The credit increases to $6,935 in 2022 for households with 3 or more children, $6,164 for households with 2 children, $3,733 for households with 1 child, and $560 for households without any children. The American Rescue Plan, which President Biden approved on March 11, 2021, offers generous tax breaks to those with low and moderate incomes. Only in 2021 will the earned income tax credit amount increase for households without children. The maximum credit for those without children rises to $1,502 from $543. Also expanded is the age range. With the exception of some full-time students, people without children will be able to claim the credit at age 19 instead of 25. Students between 19 and 24 with at least half a full-time course load are ineligible. 65 will no longer be considered the maximum age. The phase-out percentage and amount for single filers are both increased to 15.3% and $11,610, respectively. The Lifetime Learning Credit allows a maximum of 20% credit for up to $10,000 of qualified expenses or $2,000 per return, and the American Opportunity Tax Credit offers a maximum of $2,500 per year for eligible students for the first 4 years of higher education. For people with moderate or lower incomes who want to save for retirement, there is also the Savers Credit. Under this program, contributors to plans, IRAs, or ABLE accounts are eligible for a credit of up to 50% of their contributions. Depending on income, the Child and Dependent Care Credit may assist in reducing the cost of qualified expenses for the care of dependent children and people with disabilities. The Child Tax Credit was modified in President Biden's American Rescue Plan for 2021. Up to $3,000 per child will be charged in 2021, $3,600 for children under the age of 5. Also increased to 17 is the minimum age for children who qualify, from 16. Furthermore, the credit is totally refundable. Using the household's 2020 or 2019 tax returns to determine eligibility, the IRS may also grant up to half of the credit to an eligible household as an advance disbursement between July and December 2021. Final verdict. Everyone does not have to pay more, even though it is crucial to pay the tax authorities everything that is required by law. Investing a few hours researching trustworthy financial information websites and the IRS website, irs.gov, could result in tax savings of hundreds or even thousands of dollars. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go.